In March 2021, one of America's largest insurance companies got a phone call no insurer ever wants to receive. Not from a client. From hackers. CNA Financial, a company that spent decades selling protection against cyberattacks, had just become the victim of one. And within days, they did something almost nobody expected. They paid the hackers $40 million. Not to a stranger's business. To save their own. If a company built entirely around understanding cyber risk could still get taken down, what does that tell you about everyone else who buys this insurance hoping it will save them? That question is really what this entire industry is built on. Cybersecurity insurance is one of the strangest financial products ever created, because the thing it protects against doesn't behave like fire, flood, or theft. It moves. It learns. It gets better every single year. And somehow, insurers still figured out how to turn that chaos into a business worth an estimated $15 to $16 billion a year, according to reinsurer Munich Re, with some analysts expecting it to grow well beyond that within the next decade. Here's the basic idea. A company pays a yearly premium. If they get hacked, the insurer covers the damage. Ransom payments, legal fees, data recovery, lawsuits from furious customers, even the PR firm hired to stop the story from spreading. Simple, in theory. But CNA's own disaster shows exactly why this business is so much harder than it looks. Before that attack, CNA was just another underwriter, quietly collecting premiums and betting that most of their clients would stay safe. Then hackers using ransomware called Phoenix Locker got inside their own network. Employee data was stolen. Systems froze. And the company that spent years telling other businesses how to survive a cyber attack now had to survive one itself. At the time, it was reportedly one of the largest ransom payments ever recorded. The insurer became the insured. So why would anyone want to be in this business at all? Because when it works incredibly well. But getting in isn't cheap. A serious cyber underwriter needs enormous financial backing, because a single bad year can mean paying dozens of claims at once. Reinsurance alone, essentially insurance for the insurance company, can cost tens of millions of dollars annually just to stay solvent. Add the actuaries, the forensic analysts, the software that scans a client's network for weaknesses before a policy is even signed, and you're realistically looking at a startup cost north of $50 million, and that's a conservative estimate. Once you're in, the real skill isn't selling insurance. It's pricing fear correctly. Every client gets scanned like a patient before surgery. Old software, unpatched systems, weak passwords, all of it gets scored, and that score decides the premium. Fix your weaknesses, and your price drops. It's one of the only insurance products where the customer can lower their own risk just by updating a piece of software. But pricing this correctly is nearly impossible, because the target keeps moving. In 2021, when Colonial Pipeline got hit and paid hackers an estimated $4.4 million just to get its fuel systems running again, insurers across the industry watched ransomware payouts triple within a single year. Premiums that used to cost a mid-sized company a few $1,000s jumped by over 100% almost overnight. Somewhere in a spreadsheet, an actuary who priced a policy in January was suddenly looking very wrong by December. And this is where the real danger of this business hides. A house fire stays in one house. A cyber attack doesn't stay anywhere. In 2017, a piece of malware called NotPetya spread from a single accounting software update in Ukraine to shipping giants, pharmaceutical companies, and banks across the entire world, causing an estimated $10 billion in damages within days. If an insurer had too many clients running the same vulnerable software, one bad Tuesday could wipe out years of profit. Insurers call this systemic risk. Everyone else just calls it a nightmare. So how do you survive something like that? You build layers of defense most people never see. Teams that monitor the dark web for stolen client data. Negotiators kept on retainer specifically to talk ransomware gangs down from their opening price, a job that would have sounded like fiction 15 years ago. Incident response units who get woken up at 3 a.m. because a hospital just lost access to its own patient records. This isn't a desk job. It's closer to running a small intelligence agency that happens to also sell paperwork. And underneath all of it is something surprisingly human. Most business owners don't buy this insurance because they understand the technical risk. They buy it because they read about someone else's disaster and thought, that could be us. Fear is what actually closes the sale, not spreadsheets. Which is exactly why CNA's own breach became such an uncomfortable case study across the industry. If the experts can get hit, what chance does everyone else have? The biggest mistake insurers made during the ransomware boom was pricing policies based on last year's threats in an industry that changes monthly. It's like predicting tomorrow's storm using last summer's weather report. Some insurers who moved too slowly ended up pulling out of entire markets just to stop the bleeding. And yet, despite all this chaos, the profit is real. In strong years, some major cyber insurers report margins between 10 and 20%, which is remarkable for a product that barely existed at scale before 2010. As ransomware attacks keep climbing and regulations increasingly force companies to prove they carry coverage, demand isn't slowing down. It's accelerating. So back to CNA. A company that insured others against exactly the disaster that eventually landed on its own doorstep. Maybe that's the real lesson buried inside this entire industry. Owning a cybersecurity insurance company means betting that businesses will keep making mistakes and hackers will keep getting smarter, while hoping you're never the example used in someone else's documentary. In a world obsessed with firewalls and encryption, it turns out the most valuable protection money can buy isn't software at all. It's a signature on a contract, betting that chaos, when it finally shows up, lands on someone else's desk instead of yours.